I don't know whether the person who was so unhappy with the way this class is going is still with us.
Oh, really?
I don't know who it was. But I'm counting 15 of you here today. And we started off with about 25 or 27. What happened to the others? I was telling my wife at this point in the term, you know, today is the last day to drop a class, November 5th.
I thought it was the 6th.
Today's the 5th.
No, I meant the drop date. I thought it was the 6th.
The what?
You know the drop date was the 6th.
The 6th. No, that's election day. Not bad, Fee. You're close, man. Plus or minus 1 day.
One of the 6th. Yeah, my birthday's coming up.
When's your birthday?
The 7th.
Well, see?
Yeah, drop day, election, birthday. It's all
So confusing, man.
I woke up today, thought it was my birthday almost. Gotta go to class.
How old are you going to be?
I'm just 21.
21?
Oh, just 21. Not a big deal.
Yeah, big deal. Who cares? Yeah. All right. Forgot where I was going with that. Doesn't matter. What's the topic today? Monetary policy and the design of the organization that conducts monetary policy, the Fed, the Federal Reserve System. So let me just speak to the highlights. I'm going to presume, it was what I was telling my wife, by the time you get to the last drop day of the term, you're down to those students who are seriously students. So to me, this is going to be a lot more fun. Talking to you guys and knowing that the ones I couldn't reach, most of them are gone. My philosophy to her was, anybody that made it this far and is still doing okay deserves a minimum of a B in the course. Then I sobered up and, you know. I'm going to presume. Get him another drink. Yes.
So I was going to say, well, I'm going to run to the store real fast. Get you a drink. Bring him a drink every day.
No, the evening that I post grades, that's the time. Trick or treat here. I'm going to presume you've either read or very close to reading the chapter on the Federal Reserve and the organization of the Fed. So let me just hit the highlights, just without drawing too much on the board. We've got 12 districts in the Federal Reserve System, 12 Federal Reserve banks. Each of those districts has branch banks. Our district bank here is in Atlanta, but we have a branch bank in Miami. Okay? You and I don't go into the Federal Reserve banks. We call those bankers' banks. That is, our banks are customers with the Federal Reserve. They make deposits. They borrow money. Okay? So maybe a little graphic would help. Here's all the commercial banks that you and I use every day, more or less. And they belong to these 12 Federal Reserve banks. And they are transacting business with them regularly. And then over the Federal Reserve banks is the Board of Governors, the Federal Reserve Board, called the Fed for short. How many people on the Board of Governors? 12 regions, 7 governors. 7 governors. So in the hands of 7 people, you have placed incredible power. By some measures, as much power as you placed in the legislature, with how many people in the federal legislature? The House and the Senate? 535. 435 in the House and 100 in the Senate. So over in the House and the Senate, you've got 535 people. Over here, you've got 7 people, and you hope they're all sober, right? You hope they don't all go out and party together the same night, because the next day they could destroy the economy. All right? How do you get to be one of the board governors?
Elected by the president.
You are nominated by the president. And then you must be confirmed by the Senate, just the way they do Supreme Court judges. Okay? If you become a member of the Board of Governors, one of these 7 people, how long do you serve?
14 years.
14 years. No matter who comes in as the new president, he can't fire you. What happens after 14 years? You cannot be reappointed to the same office, okay? What does that mean, though? It means you don't have to do what anybody thinks you ought to do so that you can keep your office. It's not political in that sense. And we say that one of the advantages to our Federal Reserve System is that it is insulated from the political process. Compare that for a moment. If you're a member of the House of Representatives, how long is your term? 2 years. What happens every 2 years? You got to be reelected, which means you can't do anything unpopular that's going to stretch out more than 2 years. Which means your whole horizon on policy is frequently limited to what's going to be good for me 2 years from today, or less. That means it's difficult to pursue long-term policies that have short-term costs. And that's where we're caught in our political system. And by the way, that's also why our deficit and our debt is so high. We've sacrificed the long run because politicians are playing the short-run game.
How many years have we had the 7 that we have right now?
Well, that's the other thing. Each one has his term expire every 2 years. So this guy's term expired in 2008, this person in 2010, hers in 2012, this guy in 2014, which means what for the president? Even if you serve 2 terms, 8 years as president, you can't replace 4 of these guys, and you can't replace the 4th one until you're ready to leave. So you cannot control the Board of Governors as a president, even though you appoint them. And again, that just further insulates it from the political process. So they can make long-term decisions that are very unpopular and very expensive, very painful, without fear of being voted out of office. And that's going to be critically important when we start talking about the stagflation of the 1970s. And Paul Volcker, yes. All right? What else do we want to remember? In addition to the Board of Governors of 7 people, there's another agency called the Federal Open Market Committee. And because they meet about every 6 to 8 weeks, we want to recognize who the Federal Open Market Committee are. And basically that's the board of 7 governors. And how many regional banks were there? 12. The biggest regional bank is the one in New York City. It's the center of financial power and activity in the United States. Each of those banks, those 12 banks, has a president. The president of the New York City Fed is always on the Open Market Committee because it's the biggest, most important bank. And then of the other 11 bank presidents, 4 of them also serve on the Open Market Committee. And they rotate, they take turns. Typically, they all go to the Open Market Committee hearings and meetings. They all attend. But only 4 of them can vote. And they rotate out, taking turns at that. This is the real short-run policy-making group. And so when you hear anything in the news that said the Federal Open Market Committee met last week and they said, you need to turn down the music and see what's going on. Okay? Who's the chairman of the Board of Governors? Today, Mr. Ben Bernanke. And we'll say more about him as we go along. Bernanke is quite an authority on the history of the Great Depression. Turns out to be convenient, because we damn near had it again. He is controversial. Some people think he's doing too many things, or not enough things, or doing the wrong thing, and we'll talk a little bit about that as we go along. That's the organization. Some of those seats, I think there's a couple of seats still empty on the board, but as you run across, and so-and-so is one of the governors of the Fed board, you need to hush up and hear what they have to say. Because they're more aware, more informed than you and I generally. And when those 7 or 12 people get together, they can make decisions that will materially affect your lives today and in the future. And you want to hear what they're doing. Okay? That's the overview. Now the other part, which again, I'm going to ask you to be sure you read, how do they affect the economy? How does monetary policy affect the economy? And we say there are 3 quantitative tools that they have to use. Quantitative meaning they affect the quantity of money in circulation. And the quantity of money in circulation is pretty critical to how well the economy is doing. If there's plenty of money, we got money we can borrow and spend. If there's not enough money, it's tough to borrow money, it's tough to spend money. 3 tools here. 1, 2, 3. Reserve requirements. Now, I think most of this is on a video somewhere. I know it's in the book. Chapter 14. How do reserve requirements work?
Minimum banks must hold.
The minimum amount of bank must hold. This comes from something called the silversmiths or the goldsmiths principle. I want you to imagine we're back in Adam Smith's time. You ever heard of a guy named Paul Revere? What was Paul Revere all about? He rode that horse, galloping around the countryside.
Had a big axe.
Do what?
Like, had a big axe and
No big axe. What was Paul Revere's cry? The British are coming, the British are coming. One if by land, two if by sea. It was the 18th of April in 75. Hardly a man is now alive who remembers that famous day and year. And the midnight ride of Paul Revere. Oh. Paul Revere is known as the fellow who went around and told us the British were coming to Concord and we would need to be ready to fight them. He alerted us, and so began the American Revolution. But what did Paul Revere do when he wasn't riding around the countryside scaring the hell out of people? Drinking his beer? Probably some of that. Paul Revere was a silversmith. He worked in silver. Pots, cups, bowls, okay? Imagine you were a silversmith in a small, in Boston maybe. Where do you keep your silver, Mr. Revere?
Safe.
In your safe, in your vault. Have you got a pretty safe, secure vault?
Yes.
Oh, yeah, because you don't want people stealing your silver. And all of us know that Mr. Revere's got a really safe vault, a really secure one. And so when we get money in our hands, where do we keep it? Either we keep it ourselves and take the risk of being robbed, or keep it in our homes and take the risk of being robbed, or we could take it to Mr. Revere and ask him to keep it in his safe or his vault. You with that? And so we'll turn it around and you're Mr. Revere, and all these people keep coming in asking you to keep their silver. And every morning when you get up and go to work, you open up your vault and you look in there and what do you see?
Lots and lots.
Bunches of silver. And, after about a year, every time you open up and you look at it and take out the little bit you need, you think, this stuff's just sitting there. What if? Because does everybody come in at once and want their silver? No. People come in and want a little of it here, a little of it there. What if you were to take maybe 10% of that silver and loan it out? Make a little interest on it. Nobody would ever miss it. And you could be making a little interest on the side in addition to your, And if that worked pretty well, what would you do next? I'm thinking 20% sounds pretty good. And the next thing you know, maybe you're loaning out 80%, and as long as everybody didn't come in and want their silver at the same time, you're doing pretty cool. Matter of fact, you've probably given up silversmithing because you are now a banker and rich and not working very hard, right? And politically powerful or whatever, So, if it's possible to take in deposits, keep a small amount on reserve, and loan the rest out to earn a profit, is that ethical? I think so. Especially when later on the government guarantees those deposits. So if you lose them, the government pays them off. There's no risk to the depositor. You got all this money you play with. That's the beginning of our banking system. It's called fractional reserve banking. Every time somebody gives you $100 in your bank, you have to take a fraction of it and keep it on reserve. For simplicity's sake, let's say it's 10%. Strickland brings you $100, you put $10 in reserve, and you got $90 of what we call excess reserves. That's the money you play with. That's the money you lend, or you invest in bonds or something, okay? The Federal Reserve tells you what that reserve requirement fraction is. And if they say it's 10%, but then next year they come out and say, we're going to change it, it's 20%, what will that do? There's less money going to be borrowed. There's less money available to lend. What will happen to the interest rates you charge? They'll go up because there's less of it available. You got the first principle right there. When the Fed raises the reserve requirement, interest rates rise. And I'm going to call it aggregate demand, spending, decreases. Simple principle, not rocket science. And it works in reverse. If they drop it from 10% to 5%, banks have more money. They lower the interest rates, and they loan more money, and more spending occurs. Aggregate demand increases. You okay with that? Pretty easy. Okay, option 2, called the discount rate. I told you that the banks borrow and make deposits with the Fed. If you, a commercial bank, come to me, the Fed, and you want to borrow some money, I'll lend it to you, and I'll charge you an interest rate for it called the discount rate. So if the discount rate is 5%, and banks are borrowing from me and repaying the loans and everything, and then the Fed says we're going to make that only 3%, what will happen?
More borrowing.
Banks will borrow more money, turn around and lend more out. What will happen to spending?
Increase.
More spending. Bingo. Pretty simple. If you reduce the discount rate, interest rates will be down, and aggregate demand will increase. I think I'm out of the camera's range there. But you get an increase in aggregate demand.
You're good.
Okay, so far. And remember, we can always turn this around. Reduce the reserve rate, lower interest rates, more spending. So if you want to stimulate the economy in a recession, what do you do with the reserve requirement? Reduce it, right? What do you do with the discount rate to stimulate the economy? Reduce it. Make it cheaper to borrow. Okay? It's not that bad. The last one is called open market operations. This is where the Fed buys or sells bonds, securities. And to explain that, you got to imagine for a minute that there's a lot of bonds out there that are being bought and sold all the time, just like stocks on the stock market. Now to get into that, how are we doing on time? My watch quit on me today.
Okay.
What is a bond?
It's a piece of paper to pay somebody back.
A piece of paper. It's a note. It's a promise. It's a guarantee.
Like a loan.
It's like a loan. Typically, it works this way. Strickland wants to borrow $1,000. He issues a bond. He prints it up just like you would currency in a denomination. He says on there, I promise to pay you 6% every year for the next 30 years. That would be 2042. He signs it like he's important. He puts a corporate seal on it, and bingo, you got a bond. How's it supposed to work? You give me $1,000, and every year I will give you 6% interest on that $1,000. How much is that? 60 bucks. Every year for 30 years you get 60 bucks, and at the end of 30 years, I give you back your $1,000. Pretty straightforward. The early bonds were printed with a margin around them, divided up into little sections called coupons. And if you wanted your $60 interest, you clipped off the coupon for that year, you sent it to me with your name and address. I wrote you a check, addressed it, sent it back to you. If you read historical novels, you may read about, how's old Johnny George doing these days? Well, he's doing pretty good. He's clipping coupons. Clipping coupons was a euphemism for he is very wealthy. The only thing he has to do is clip off his coupons and send them in and get his money, because he's got so much money in bonds. He's not getting ready to go shopping at Publix with clipping coupons. He's wealthy. Okay? From that also, because you're going to be doing some calculations next class, the 6% on the bond is called the coupon rate. That's the coupon rate. And the denomination of the bond is called the par value. Those are printed on the bond. They don't change. You own that bond, you always get 60 bucks. I want you to read the handout on bond prices and interest rates before next class, and bring a calculator. We'll do some fairly straightforward calculations with that stuff and knock it out. We doing okay so far? Okay. Let's pick this up, because we'll come back to it again, but if the Fed buys bonds, just take it from me for the moment. What that does is, if I'm the Fed and you're the banks, I'm going to buy your bonds. What am I going to give you for those bonds? Money. So am I putting more money into the economy? Yes. So when the Fed buys bonds, that puts more money out there for you guys to lend. If you want to lend it, you charge lower rates to attract more borrowers. What will that do to aggregate demand? Cause it go up. Lower rates, more spending. If the Fed sells bonds, you get the opposite. I'm selling you my bonds at a very attractive price. You give me your money, so there's less money. You charge higher rates for the money you are lending, and you depress or reduce the level of aggregate demand. You okay with that? 3 tools of monetary policy quantitatively. There are 2 qualitative tools, and the discussion on bonds that I want to accomplish next class. You might want to take a read through that. And then I will leave you with one other thought. And I don't recall where it is on the schedule, but there is a discussion on stagflation and a pretty ugly graph or two we're going to draw. If we get into that, if we can, we will get into that beginning Wednesday. And if we don't, we will certainly do it a week from today. No, we won't. If you come in here a week from today, what will happen? You'll be by yourself. Why will you be by yourself? Because you have no friends, no? Because it's Veterans Holiday, okay? On Veterans Day. What's happening this coming weekend? You have homecoming Friday, party, recover Saturday, recover again Sunday, take Monday off because it's a holiday, right? Don't get behind. This is the critical part of this course. Anything else? Peace.